From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB. I'm Juliette Sarli. It is Tuesday. What day are we? The 17th of December. Let's have a look at where the local market has finished the session. Look, we thought we were going to have a negative day when we came in. Futures were suggesting a drop of around 0.5%. Instead, we have rallied quite nicely today, mainly thanks to some big buying coming through in the banks. Just when you think the financial sector can't ratchet any higher, we get to the themes of the day, which is, of course, that banking boost and CBA. If not hitting, then getting close to a record high again today, really lifting the overall financial sector. But there was some good moves coming through from a raft of sectors today. In fact, it was really just the energy players on that weakness in crude that weighed down the overall momentum. An iconic return of an iconic Aussie brand, SPC Global, re-hitting the market after a near 20-year absence. Remember that Coca-Cola Amatil bought SPC back in 2005 for nearly $500 million. They sold it in 2019 for $40 million. And then, of course, it merged with the Orange Juice Company and Nature Dairy and Nature One Dairy, and they have listed again on the market today. A little bit of a lackluster response, though, tepid response, if you will. I'll talk about that with our guest, Mark Gardner from MPC Markets shortly. And then, are we gloomy again? We had two consumer sentiment readings out today, the ANZ Roy Morgan one, which is, of course, weekly. And I spoke to Maddie Dung from ANZ. She said basically it is the essence of we're in that lull between the Black Friday sales and the Boxing Day sales. So potentially consumer sentiment is stalling somewhat, but the more broad Westpac consumer sentiment survey also showed that we're not as optimistic as we were, and potentially that is as we continue to hear that the RBA is pushing out those interest rate cuts. Let's have a look at the sectors today. I mentioned the banks certainly doing very well. CBA shares at $161.11. So if not a record, very close there. Macquarie also looking very, very good. Having a look, at the tech players, we had some good moves once again on the NASDAQ, back about 20,000 points. Xero there up 1.5%. Zip up 2%. Couple of people with really bullish calls on Zip, even though remember their stock has risen by 200%. I asked Zach Riaz from Banyan Tree, outside the office, I should say. Andrew spoke to him on air, and he said, look, momentum builds momentum, and he certainly still likes that stock. And then having a look on energy players, a little bit mixed. We did see crude, of course, retreat on those China concerns. Quick look at some of the other stories out there. Data3 falling. It's announced changes to its partnership with Microsoft, which would reduce the incentives earned from its current agreements. Shares in Karoon Energy also plummeting after the energy company downgraded its outlook. PEXA, the Commonwealth Bank backed property settlement exchange, rising after it appointed a successor to outgoing CEO Glenn King. Novonix also rising. It received a conditional $755 million loan from the Department of Energy. And APA Group there also in focus. Quick look at some of the other stocks. Westpac announcing Michael Rowland will retire as Chief Financial Officer. Southern Cross to sell some of its TV license to Network 10. Perpetual says that an independent board expert has determined that its plans to sell one of its businesses to KKR is not in the best interest of shareholders. And of course, we mentioned about SPC coming online for the first time in 20 years, and shares fell today by more than 20%. Let's get more on that with Mark Gardner from MPC Markets. Good to see you. I mean, less about SPC, but more about that thematic of why we're seeing sort of lackluster or tepid response to some of these IPOs.
Strange time of year, and also considering basically the only big IPO, or really the only IPO we've had this year is GYG. So, I mean, that one's done quite well and had all the ingredients because obviously, you know, it was very early on backed by Barrenjoey, etc. and low free floating stock, which does help it, help the market go up. But yeah, very strange to be IPOing in the in the second odd week of December overall. I would have thought people coming back in the new year, probably a little bit more interested in their portfolios, etc. Probably too busy Christmas shopping at the moment. For a lackluster year of M&A or IPO activity and listings, very strange to pick this sort of timing now to be going and doing it. an IPO, and so yeah, I'm not surprised, but a 22% downturn on the first day, obviously not great, straight off the bat, and then obviously DigiCo the other day.
Which was, as Henry Jennings put it, DodgyCo, potentially. Let's look though more broadly, because it is about the central bank bonanza this week. We're very much expecting a Fed cut. We've also got Christine Lagarde saying, look, the ECB could cut again if inflation warrants it. BOE, Bank of Japan in focus too.
Yeah, so I mean, I think Bank of Japan is obviously a slightly different case. I think Europe and the UK particularly, they're not in great shape overall. So I think cuts are justified there. I'm in the very small minority camp that I don't think there's a chance the Fed doesn't go this week, and I just think there's a lot of uncertainty around Trump. There's a lot of uncertainty around tariffs, which is short-term inflationary. They've already gone very hard at the start. The only thing really that could potentially be pushing them and a little bit of urgency is that bond yields haven't fallen since they've cut rates, and maybe they're trying to, they might attempt to try and drag them down via the very blunt instrument of the benchmark rate, but. I'm not entirely sure whether that's going to change anything. We still have, you still got pretty good economic numbers over there. Manufacturing numbers in the States not as well with ISM. So, look, if you start to see numbers where, numbers or anything with any sort of strength in that manufacturing or in the services index there for ISM, it's going to put the Fed in a pretty hard position because they've gone hard thinking that employment was going to drop down pretty quickly, and that was September. We're 3 months through that now, and nothing's really happened. If anything, the figures have gotten mildly better, and obviously, and the stock market's gone through the roof. So it's a very odd scenario from a historical context to have an aggressive easing from a central bank when you've got assets at record highs, unemployment at record low. I question the validity of them moving. The market really wants it, and there's been really no one giving the other side of the coin. But from an economist's standpoint, there is nothing that justifies beyond the 50 that they did first up. 50s to start with a 50. That's only ever happened in the past, and basically responding to black swan events or an economic shock. So, I really do doubt, I doubt that they need it, whether they, I think it's about 94% is the market's pricing in, but I think
get
they can
it
wait.
in before Trump comes in, and then you kind of think about the entire cycle. I know they're meant to be independent, but that sort of seems to be the potential.
Yeah, look, he's reassured Jerome Powell after saying he was going to get rid of him. That he'll be staying there. I don't see it making a huge difference whether it's in December or whether it's in February. And you've had Michelle Bowman come out and say that she doesn't think inflation's under control. Well, if you don't think inflation's under control, unemployment rate's at 4.2. We haven't had a negative payrolls number since December 2020. Why do we need rate cuts realistically? And they keep harping on about higher for longer. So I do think they're just a little bit of the rhetoric coming out, particularly the Bowman comments. I think put a small seed of doubt in my mind that there might be an unexpected no change, and then that gives obviously you start to see what Trump's going to actually enact. So I mean he says a lot of things, but what actually gets put through, and that inauguration's around January 20. So yeah, this seasonally is pretty good time of year. The last 2 weeks of December, the first 2 weeks of January, particularly for the US market. So and basically, if they do cut, I think we just drift higher over the course of the next 4 weeks.
All right, well, seasonally, as you say, normally a good time. I actually had a great chat to Jonathan earlier today about seasonality, but, apart from today, which is looking pretty good, we're not really seeing when was sentiment to come. We've had a couple of days of big losses. What, with your crystal ball outlook, is sort of the rotational move in 2025 if 2024 was kind of the year of the banks?
I think resources are extraordinarily cheap here at the moment. Energy stocks are a little bit of a risk because of Trump's policies on energy, but I do think that the likes of the next phase of AI is really going to be about building those data centres out. The power, I think you're going to see the likes of copper, uranium, And obviously, to a certain extent, probably a little bit of an increased demand for iron ore as well as China sort of comes out of the doldrums. So and the resources sector really has been, it's been horrible this year, but you've got really high quality companies coming into demand for their commodities at extraordinarily cheap prices. And if you're hunting for yield, it's the only place you can really get yield here at the moment. CBA is yielding the least. All the banks are yielding the least they've ever yielded, pretty much. So I do see that there'll be a bit of a rotation, back into the resources. And when that, or whatever the catalyst is that starts that off, I don't necessarily know. But I think the tech sector particularly has a fairly major risk there in the US next year, because there are, we've had the best 2-year rally pretty much in history for a higher rate environment. The only one that even remotely compares is the 90s, and rates went from 17.5% to 3% in the decade leading up to that. So that was fairly justified. But statistically speaking, single-digit gains next year for the American market would be a good result, basically. So
what is it, up 20% or something? The S&P?
Mid-20s basically. It's close to 60 for 2 years. So I think investors probably need to pare back their expectations, because you don't tend to, we're very, very unlikely to get another 20. And you could start to see some pretty big cyclical shifts. I mean, the likes of Broadcom rallying in the last few days, you're starting to see where there's hyper earnings and hyper revenue, like for the likes of Nvidia, etc. It's just how capitalism works. People start to catch up, and I think that the rally will start to broaden a little bit. And I think next year will be about those picks and shovels for the AI thematic, but also the early monetizers, like Salesforce is starting to roll out their AI agents now, which is. It aggregates the data at the moment, but this thing, it will actually then go and do something with it for you. And they're starting to see sales on that. But those companies that start to monetize early, I think will be the massive winners next year. But the chips and etc. I think it'll be more about the software and the rollout to monetization overall. So the likes of Microsoft will still probably do very well. Yeah,
if you had a 20% return every year, you wouldn't need a casino, would you, Mark?
No, you would not. You would just sit down and compound.
Exactly. All right, thank you as always.
Thank you.
Mark Gardner from MPC Markets. Well, the stock of the day was SPC Global Holdings, making its return to the ASX after 20-year hiatus. Ben Clark from TMS Private Wealth and Michael Gable from Fairmont Equities joined Koshi.
Yeah, look, we've seen a few sort of recent listings, and in the food space we've had the Guzman and Gomez listing as well, and that did well off the bat. I mean, looks like SPC's not doing well off the bat, and the market's up today. So, look, maybe one to investigate a bit further, but I think that growing conditions, ag conditions here in Australia have been pretty good the last year or two, and the outlook's looking pretty good for next year as well. So, I don't know what price is fair value for SPC, but I suppose it's one worth keeping an eye on.
Prospectus was issued, so as you get with an IPO, and at a very minimum, I'd have a good look at that and have a look at where the new shares were issued, because although that shows a drop, that might be where it last traded, versus where it's been recapitalised or new stocks been issued. That might be at $1.50. It might be up today. So you need to do a bit more work.
Making me want some canned peaches. All right, let's have a look at the market leaders on a down day. PEXA, we mentioned changes at the C-suite, up almost 8%. Some good buying in some of the gold players, Westgold and Regis looking good. SiteMinder also had a good day, as did AUB, to the downside in the large cap stocks. We mentioned Data3 coming under pressure to the tune of around 10%. That change with its Australian Microsoft partnership. Karoon issuing a profit downgrade, down 9.5%. DPLO under pressure, but Andrew had a great chat with Sean Hickman from Market Matters earlier about some of the uranium players, and Weebit Nano and Sayona Mining also under pressure. To the small end of town, Is that right? That doesn't look right. Let's ignore that. Let's flip the board quickly. Never wrong for long. SPC Global is down 22% on its market debut. As Mark Gardner just said, maybe not the best time, particularly as everyone's unwinding and not even looking at the market in the lead up to Christmas to debut. But anyway, Aura Energy down 13%, Optiscan Imaging, Titomic and Lindian Resources. Having a look at what we are expecting tonight, retail sales and industrial production in the US for the month of November, and also the December housing market index from NAHB. Tomorrow, not much happening. I know that NAB has its AGM. We also get the Westpac Melbourne Institute leading index of economic activity, and over in Japan, their trade balance, which of course is key ahead of the Bank of Japan decision. Final check of where the market is tracking, and it was a good day today, up 0.9% there on the CBO 200. The ASX 200, I'll just get you a quick check of where it is. 83.17, I see it, up by about 0.8%. Really thanks to this big push once again from the banks. I did a bit of a drill down into the banking sector, as we know, something like a 40% gain over 2024, and a lot of that thanks to index leader CBA hitting another or getting close to a record today of $161. So that has really helped push the overall market higher. Mark just told us perhaps 2025 will be resources time to shine. All right, that does it for this Tuesday. We will be back bright and early from tomorrow. Have a good evening, and we'll see you from 9:45 a.m. Eastern.